Welcome back to Primary Source China Investments. Peng Guo and I are here for another show, and this week we're going to get into it with show N5. And what we're talking about this week is Chinese investors are being rational. I mean, if you look at the headlines, and they've been bombastic about the capital outflow, the biggest outflow in years since 2015, and billions of dollars are outflows. But it turns out that Chinese investors are rational, and the most rational investors are the foreign investors. Why don't we take a look at how we got here, Peng Guo, right? So there are three reasons I think we're here at this point. Returns in both equity and fixed income have changed for US dollar investor. If you look at the S&P 500, it's up 12.5 this year, and NASDAQ is up double that. Second reason, fixed income returns, or more accurately, cash in the US has gotten very attractive. And then finally is renminbi depreciation. So if we just look at these three items, China's 10-year government bond yield has halved in the past 10 years. And since November 2020, it's gone from 3.4 to 269 in that time. Renminbi depreciated from 655 to 7.11. That's 11.5%, effectively killing any attractiveness for US dollar investors. What do we make of this, Peng Guo?
In my opinion, it's all about the cycle. So this is different cycles. Obviously, if you do the simple math, and SP 500 get a much better return compared with the China market performance plus the currency depreciation. From US investors' perspective, it's good to stay in the US market.
Yeah.
But the bottom line is in China and the US, they are in a different business cycle.
So we know the why. How about the what? What's the breakdown, right? These headlines where 49 billion was taken out of the China market. And so how does that break down? So 29 billion was in equities and fixed income. Foreign direct investment deficit was another 17 billion. And the remaining billion or so was from a long-running services deficit as China travel hasn't picked up. And 49 billion sounds like a lot. And you need to map that against the size of the equity and the fixed income market and also the FDI numbers. If you look at 49 billion and realize that foreigners only own about 5% of the secondary market assets, the equity and fixed income, you start to see, well, is this really relevant? The stock market in Shanghai, Shenzhen, and even Beijing, if you want to add that, is 13 trillion. The fixed income market is another 20 trillion. And for those of you that don't love calculating with all those zeros, 49 billion is 21 basis points. The bond market loses and gains that in seconds. And like we've talked about time and time again, China is a domestic market.
That's right. Foreign investors, they have a much smaller percentage. But in China market, they have a bigger influence compared to their percentage they hold. So most of the time, if this one form a trend, that will affect the market. I believe that also could trigger, have some more people follow them.
So do you mean that because if foreigners are buying, that's good sentiment, and if foreigners are selling, that's bad sentiment? Is that what you mean?
I mean, like they have like an indicator showing like the they call the 北上资金. That means the money came from Hong Kong, flow into the China security market. And those kind of the money represent from the overseas. So they believe they do the more research and they have a more understand the China market better. So that's get a much larger influence.
So foreigners entering the market is a little bit different than foreign brands entering the market. And we should track all of this and put it into perspective because things have changed. You know, why should I buy Starbucks when Luckin or Coty is just as good for a lower price? Even if Starbucks in China just opened their largest manufacturing plant outside of North America, and after 25 years in China, they are vertically integrated. But there are plenty of retail and wholesale products facing this existential question. Why do Chinese people want or need Nikes or Adidas when they can have Antas and Li Nings? I'm not being glib. If your brand isn't a necessity on the mainland, you could absolutely be in trouble. And even if your product is currently a necessity, it may not be forever. Looking at you, Boeing, will the Chinese people revolt if they can't have their LV bag or Apple phone or their semiconductors from Qualcomm versus SMIC? I don't think so. So you're looking at a displacement. The pie may be getting bigger, slower, but it's getting bigger for Chinese brands as well. What's your thoughts, Peng Guo?
I think right now it's more complicated. Like the Nike, they have a really localized, so they get a wider relationship with China manufacturer. They have other Chinese companies. So they might cooperate, they might compete each other, and also they have a complicated distribution and channel as well as the relationship. So they are getting more and more local.
Yeah, China is really a local brand. I mean,
people, yeah, they don't think, they really not treat them like they more treat them like a global brand rather than local brand. I think that looks like a difference.
I totally agree with that. It just brings us back to a recurring theme, though. If you're allocating to China, you need to find companies that serve the Chinese people first and foremost, are based on the mainland, and are traded on the mainland and aligned with Beijing, either expressly or implicitly. Otherwise, you're taking risks that you may not be compensated for. And I think we've talked about this time and time again, looking at individual sectors, individual names in those sectors. Those companies that are currently aligned with the strategy of Beijing and the Beijing people are the ones that are going to do well and continue to do well going forward.
I totally agree with that.
Yeah, the final point I wanted to make is something I tweeted out earlier this week is China may have gone maybe the fastest market going from totally uninvestable into totally undervalued, or a bargain right now. I would just be cautious to investors that are looking for getting in low. The PE for the CSI 300 is definitely low. It's probably 11.7 now, but it has gone lower before. It obviously has been higher in the past. Just buying and selling, trying to market time, usually leads to more losses. Well, and with that, we're going to leave it for show N5. Thanks for tuning in, and we'll see you next week.
Thank you.